In this video, we're going to get our hands a little bit dirty and look at the transactional cycles and walk through how we would audit it. My hope is to expose you to how a transactional cycle actually works and then discuss some of the audit procedures we would use to nail down our assessments of control risk. In our next lesson, we will discuss the substantive procedures that are necessary to reduce our detection risks efficiently. For this video, we're going to use the sales cycle, which is typically comprised of the following accounts: sales, returns, bad debts and allowances, receivables, cash receipts, and commodity tax collection. Let's first describe the sales cycle from cradle to grave, and I want you to make note of three things. First, understand the types of documents and journals, and this is really to build up your vocabulary. Second, understand how the processes work. That is, how do dollars find their way through the accounting system onto a set of financial statements? And thirdly, understand how internal controls are overlaid on the processes to ensure the integrity of the system. So, let's get started. Sales often start with a request for product. In a retail store, the customer brings their desired purchase to the checkout register. In our hotel, a customer makes a reservation. In a manufacturing business, a customer will submit a sales order. For a cash-based business, such as our retailer, authorizing credit is not all that important. But for our hotel and our manufacturer, we need to confirm the creditworthiness before accepting the order. If we are planning on extending credit to these customers, this process becomes all the more important. Otherwise, a credit card number would often do the trick. The next activity is to actually ship the goods or deliver the services to our customers. This isn't an issue for our retailer, obviously. For our hotel, we are delivering a service, so it too isn't much of an issue. However, for our manufacturer, we are actually going to have to pick the order and load it onto a truck for delivery. The documents you will find here will include a picking slip, which gives instructions to the warehouse staff as to what the customer has ordered, and a bill of lading from the carrier documenting what has been loaded onto the truck. Once the product is shipped, it needs to be invoiced. The billing department will prepare a customer invoice with the quantity shipped at the price agreed to. At this point, the data starts getting recorded in the journals and the ledgers. The sales journal will summarize the sales activity as we have now achieved revenue recognition. That's the credit side of the entry. The debit goes to our accounts receivable subledger to track the customer's balance outstanding. At month end, we may send the customer an account statement, which will summarize activity in their account, including their purchases less returns and remittances. For reporting purposes, you will see the management review what is called an age trial balance of the accounts receivable. This document lists both the balance outstanding from each customer and how old the balance is, often grouping balances into current, under 30 days, 30 days to 60 days, 60 days to 90 days, and over 90 days. A very helpful report for managers to use to manage the working capital of the business. At some point, the customer will remit payment. They may send cash, which is unlikely in today's environment, a check, or an electronic fund transfer. Cash or the equivalent will get deposited at the bank. A lockbox is an arrangement whereby the remittances are sent directly to the bank for deposit. The collection of cash gets recorded in a cash journal, which debits cash and credits the receivables subledger. Now, if the customer returns product, a credit memo may be issued. In the accounting system, this too relieves the customer account with an offsetting debit to inventory. Bad debt arises when customers don't pay us. The allowance is a provision for anticipated bad debt. A write-off is applied against the provision once the company loses all hope of collecting the account from the customer. Now, to finish off our story, subledgers and journals roll into the general ledger, either on a transaction-by-transaction basis or often on a batch basis. A batch basis simply means that the transactions are aggregated and posted as a single entry in the GL. The general ledger balances at the end of the period become your trial balance. Your trial balance will then get grouped, matching up like accounts for reporting purposes. And the group trial balance will enable you to draft your income statement and balance sheet. And from there, you can draft the rest of the financial statements. This is your financial reporting process. And I emphasize process because we have not yet talked about the controls whatsoever. Don't get these confused. Let's go back now and talk about the controls that overlay the sales cycle process. We have already spent a lot of time talking about the internal controls in earlier lessons. So I'll try to keep this discussion brief, but hopefully you begin seeing the pieces falling into place. The starting point for all cycles will be to consider entity-level controls and general computer controls. For example, if you have a highly driven sales organization with significant emphasis placed on growing sales, this may lead to a management bias. This could motivate the salespeople to conjure up sales, or the credit people to accept less credit-worthy customers. So always remember to consider the control environment before you get into the details, as this has a pervasive effect. Now at the customer order stage, we will want to have some controls over ensuring that the order is input accurately. Remember those annoying red text warnings you get on the website when you're miscompleting a field? That's an input control, which helps cover off the accuracy assertion. In our retailer, we will want to have other controls such as barcode scanners that do the same sort of thing. For our manufacturer, credit approval is a key control, as this prevents us from taking on customers that lack creditworthiness. This control helps us with our valuation assertion. In the warehouse, the shipping documents will be tracked and ideally serially numbered. If these documents are tracked and compared to the sales invoices, either manually or electronically, this helps ensure the completeness of sales. Occurrence is validated by ensuring that only those orders that are actually shipped get recorded as sales. So if an order is, say, back-ordered, it should not show up in the sales journal. Segregation of duties is an important control which prevents any self-review bias as well as protects the organization from theft. Those handling the cash remittances should not be the same as those maintaining the subledgers. Those handling the invoicing should not have custody of the assets. Management's review of the aged receivable listing helps ensure that the allowance and the bad debts have been adequately considered. This is your valuation assertion of accounts receivable. The customer statements act as a control of sorts. Not all customers send customer statements, but for those who do, one added advantage is that if a customer notices something is amiss, like a payment has not been applied to their account, or they're being charged for something they didn't order, rest assured that they will call you. So this helps to ensure both the occurrence of sales and the existence of accounts receivable. The issuance of credit notes and the write-off of bad debts is important from a control standpoint. So once again, segregation and authorization controls must be in place. I think I've given you enough examples so that you begin to understand how controls are overlaid on top of the sales process to achieve management's assertions and our audit objectives. A well-designed system of internal controls will have a mix of preventative and detective controls which may be manually or electronically performed. Our role as auditors will be to identify the controls which best address each of our objectives. Now, for argument's sake, let's just focus in on the existence and evaluation of accounts receivable. We can go through our internal control documentation and identify the key controls that address those particular assertions. Maybe our bad debt allowance is system generated based on the aging of receivables, in which case we'll want to rely on the system's ability to age the receivables properly and would identify a processing control in the application. For the existence assertion, the customer statements may be a key control. But how do we know that someone is just not pulling out the statements going to the fictitious customers before they are mailed? Well, in this case, we would need to ensure adequate segregation of duties and would identify that as a key control. Perhaps that control in and of itself is not enough for us to reach our warm, happy place. Maybe we need to identify a control over ensuring all shipments get invoiced as our key control. Does that make you feel better now? It's a judgment call as to how many controls and which controls you identify as key controls. Do you remember what happens next? That's right, you need to assess the control risk, which again is based on your judgment. We will just pretend that this is a client that has a well thought out and implemented system of internal controls. And for this reason, we will assess control risk as low. If we had weaknesses, we would have to assess control risk for those audit objectives differently and tailor our audit approach accordingly. Most of the stuff happens during the audit planning stage. This takes us to either our interim field work or our year-end field work. What happens now? That's right, we have to test the controls to support our reliance. And for our system aging control, we could test the control in a variety of ways. We might manually reperform the aging analysis, Or we could process some dummy invoices with different dates to test the aging algorithm in the system. To test the segregation of duties, we could observe the task being performed. We could make inquiries about the performance of these tasks throughout the period. Again, these kind of feel like weak sources of evidence to me in and of themselves, so we had better take a look at a second key control to test this assertion. We were also going to ensure that the receivables actually existed by vouching them back to shipping documents. So here, the test of control might be to take a sample of the sales invoices and ensure that the shipping documents are attached, signifying that the person who entered the sale has entered the sale only when they had appropriate shipping evidence. If our findings support our beliefs about the control risk, then we'll move on to perform our substantive work. Otherwise, we may need to return to the audit plan and recalibrate our audit approach for any surprise deficiencies we've noted. Now, keep in mind that I've picked out just a small sample of the work that an auditor would actually perform for illustrative purposes. In fact, the amount of work performed is a matter of auditor judgment. It is likely, though, that if you want to achieve a low control risk assessment, you will need to make damn sure that the controls are effectively working throughout the period. But hopefully this is enough to give you an idea as to what this looks like. And then when you get the opportunity, you can apply the same sort of thinking to the other audit objectives of interest for the sales cycle and for the other cycles. So before we go, let me just show you one form out of the CICA's Professional Engagement Manual that can be used to document these sort of findings. The sort of working paper presented here, it's a summary of the assessed risks. So you can see that there's an area on the worksheet for assessing the inherent risk and the control risk. The residual risk is kind of what's left over. That's really your detection risk. And you can see on this first page, you're really scoping out the high level, the pervasive risk that may have an impact on the risk of material misstatement. On this second page, you would look at the different cycles and assess the risks on a cycle by cycle or assertion level basis. And you can see over here we have our assertions. C, completeness, E, existence, A is accuracy, V is valuation. So you can see that for instance, our sales cycle, we'd fill in sales cycle, the business processes that are associated with that sales cycle, so perhaps it's our sale of hotel rooms, and then we'd fill in each of our assessments of control risk. Our residual risk would be the risk that's left over after the inherent and the control risk have been established. And then notice that we would document our reason for assessing the levels of risk as we have, as well as documenting our response, which we'll pick up in the next lesson. So until next time, don't stop till you get to the top. When you get to the top, don't stop.